Amid a deluge of earnings this week, will investors see growth that justifies recent gains? Welcome to Market Insight. I'm Elena Casas. 169 of the S&P 500 companies report this week, and they're under pressure to show that earnings are strong enough to underpin recent sky-high valuations. Many have deliberately guided expectations downward ahead of publishing their numbers, despite data showing a consistently resilient US economy. Joining me now to dig into what to expect is Keith Gangl, Portfolio Manager at Gradient Investments. Keith, hello. Let's start then with today's headline news. Alphabet reporting after the bell tonight. Are those numbers going to show their investment in AI is paying off yet, do you think?
Yeah, we think so. Obviously, we have five of the Magnificent Seven companies reporting tonight, so this will be the first one. And again, expectations are very, very low. Valuation on this one's the cheapest of the group. It's at 19 times. It's got a good growth rate. The question is, will all these investments in AI start to pay off? So it'll be the first sign tonight when Alphabet reports, but we're very positive on it. So we'll see what they report.
Tomorrow, of course, we get numbers from Meta and also from OpenAI owner Microsoft. Are they going to hang on to the lead they got there in the artificial intelligence space, do you think?
Yeah, we like those names as well. And again, those are a little more expensive, but they have a little bit of higher growth rate. They're trading at 24, 25 times. Their growth rate's at 16 times. Now, to put this in perspective, the overall S&P 500 is trading at around 21, almost 22 times for about half the growth rate of these large mega cap companies. So we definitely like them. They're spending on AI. We like to see some of this revenue start to follow through, and that's exactly what investors are looking for on this call.
I know you like healthcare stocks, Keith. Let's look at some numbers we already had out this morning. Pfizer beat estimates after struggling with lower vaccine sales after the pandemic. Is that a pick of yours?
Yeah, we kind of like healthcare in general. Pfizer is one of them. Pfizer's a name that's really, really cheap. It trades at 10 times. Healthcare in general hasn't been light with the big boom and the Magnificent Seven working. Healthcare has kind of been left behind, but growth rates for these companies are very reasonable. Pfizer just put up a good quarter. We've seen some good quarters last week out of Abbott and like Boston Sci. Those are med tech companies that we like. Again, good growth rates. They've kind of been ignored by the market. We think that's an opportunity to look at these names.
Why have you picked out healthcare as a sector to follow in particular?
Well, just because, again, the durability, this year has been really strong for the market. Last year was strong. If we get to more of a choppy market for next year, we think healthcare is an area that people can rotate into them because valuation is very reasonable. They're very durable. They have about 10% EPS growth as a category. So we think that's where some people will rotate to. They've been left behind and kind of ignored. We think that could be the sector that works next year.
Treasury yields are at new highs today. They've been rising over the last couple of weeks in what's being seen in some quarters as the bond market pricing in a Trump presidency leading to a higher US deficit. What do you make of it?
Yeah, I think a little bit of that's true. I mean, obviously, the poll numbers are picking up for Trump. I think that's kind of contributing to it. The other part I think is a little more important is I think the economy is overall stronger than expectations. If we go back a month, the economy is starting to slow down. The jobs numbers we've seen recently have been very strong. So that we'll see a number on Friday as well if that's going to continue. I think that may take the Fed's easing, their pathway of, cutting 50 basis points last time. Expectations are for another, 25 to 50. We're in the camp that's going to be more like maybe 25, could be even zero, especially if the economy remains resilient.
Do you think a strong jobs report could throw off most people's forecasts for the Fed's next move if it comes in hotter than expected?
I do. I think if it is stronger, I think that expectations at 25 to 50 drops to 0 to 25. We like a strong economy. We'd rather have a strong economy, people working, driving the economy that way than depending on the Fed to cut rates to drive the overall stock market.
And of course, there's just a week to go before the election. How do you think investors should be positioning for potential volatility around the vote?
Yeah, there'll be a lot of volatility, but we always tell our clients is keep your political decisions separate from your investment decisions because markets tend to go higher regardless. The one nice thing about getting this election behind us, we'll have the results finally next month at some point in time. It may not be the day after, but we will see who's going to be leading the country going forward. And again, we invest in companies, not politicians, so it'll be nice to get that noise behind us.
Thanks so much for that analysis. Keith Gangl of Gradient Investments. And that's your Market Insight. Don't forget, you can watch more videos on Reuters.com.